Welcome in Why Finance. Today we are going to investigate for financing by debt instrument. Usually when we have a big project and we are having a shortage of money, we use debt. Maybe these projects can be on governmental level or business level. So what are the different type of debt instrument? We can have a long-term debt instrument and we can have a short-term debt instrument. So what are the difference between of them? Let's start by the short-term debt instrument. It can be working capital loans, it can be short terms, it's also related in government, it is called treasury bills. And this can reach a maximum of 3 months. So I can go for a government or I can usually also go for businesses. But what about the longer term debt instrument? We have two types of long-term debt instruments. The long-term loans, debentures, or the mortgages or the bonds that a lot of businesses and corporates and real estate use it is called mortgage. But today we are going to look specifically how we can make valuation for bonds. What is the debt instrument? So we are going to look for the relation basically between the government and the bank. Usually in many governments, we have what we call it government deficit. Government deficit. So how we can finance this deficit? This deficit means that the gov expenditure is more than the gov revenue. So we are having a shortage. How we can fulfill this shortage? So one of the instruments that the government uses, which is called that we are even going to look for the monetary policy. We are going to issue these types of bonds, and this is the topic that we're looking for. Who is going to have these bonds? They are going to provide these bonds to the CB, central bank. And in return, the CB is going to give the government, as you see here, the dollars. So nothing for free. What is the return? When the government is going to return back the money, she is going to return it back with the cash, which is the principal that we have in addition to the interest rate. So how much is this interest rate? This is what we're going to do. Since it is a contract, and this contract is a longer term contract, so I have a interest rate that we agree upon. But unfortunately, by time, the market rate is going to change. So our task today is to calculate the value of the bond at present. So we are trying to do what we call it bond valuation. What do you mean by bond valuation? Which means we are going to calculate the present value of the bond, taking into consideration, as we have been seeing in the previous video, we're going to discount the value of the coupon rate, the coupon value, the coupons that we have it. In addition, we're going to discount the principal that we have. And this is what we're going to look for. So pay attention again. The government need money, so they are going to issue these bonds, which we are going to see it in the following slide. And then when the bank receive it, and then he going to give the government to the money, which we see it in the forms of the dollar that are flying from the bank to the government. And then in return, when the government give back the money to the banks, they are going to return it with interest rate. So we're going to make a calculations how much is the value of money right now, and we determine the valuation of bond. So what is the bond? As you see here, this is one of the US bonds, and it is a long-term contract under which borrowers agree to make payments of interest and principal on a specific date to the holder. So as you see here, we have here what we call it the value of the bond. They usually issue the value with a $1,000. So it is important to see this 1,000. So if I need 1 million, so I will multiply it times 1,000 times 1,000, so I will have the million. In other words, bond represent a long-term debt. It is, as we said before, it's a debt instrument. From the issuer point of view, it's a debt. I'm financing my deficit. And in a security for the holder. So if we go back to the slide that we have just finished, and we see who is the debt instrument, so the debt instrument will be from the issuer point of view. Who is the issuer was in our previous slide? The issuer was the government. So the government will be the issuer. And here, this is the issuer, so it is will be a debt on the government. And here it will be a security and it is an asset for the bank. Very nice. So we clarified the difference between the issuer and from the point of view of the security of the holder of the bond valuation. So what is the factors that going to affect this bond? Sure, we have what we call it the face value, which will be repaid back at maturity. What is the face value? It is either the $1,000 that we have it and it's multiple. And then the coupon rate. So let's say, for example, if I'm going to issue a bond with a $1,000, and this is the amount of the face value which are going to return it at maturity at the deadline. The maturity means the deadline. And I look for the interest rate. No, it is not an interest rate. It is what we call it. This $1,000, I'm going to have over it a coupon rate. So how much is this coupon rate? So let's say if the coupon rate is 10%, then the coupon value will be how much? It is the 1,000 times the 10%. Then it is 100. If it is 9%, so the coupon value will be, if it the coupon rate is equal 9%. This means that the coupon value will be how much? It will be 90. And pay attention, this is what we call it annually. What you mean annually? And per year. So if it is not annually and it is semi-annually, then I'm going to divide this 90 divided by 2. So each 6 months I'm going to pay the 45. So this is the main points that we need to look for, the factors affecting the bonds. And then we have what we call it the tenure, number of years till maturity. What will be the number of years? It can be the contract, how many numbers of years? It's 10 years, 5 years, it depends on the contract, which is the debt instrument that we have. So we have 3 factors, the face, the coupon rate, the tenure. Let's go back and see what we have in the most important factors. Since we are talking about the coupon rate, so we need to differentiate between the real rate of interest, which is created according to the market forces, the one side supply of investment, and how this inflation affects me. So the real interest rate is determined in the bonds market, which is the most important market. And in the bonds market, we determine the nominal interest rate. So this nominal interest rate is the actual rate where the buyers and sellers are looking for. But the nominal rate differs from the rate of return. What it is the difference? We are having the inflation. So let's precisely determine what is the difference. So if I'm trying to write the real interest rate, what is my real interest rate? So my real interest rate, it is the nominal interest rate, and then I'm going to subtract from it the inflation. So this is one way to determine the real interest rate. Or another way, that when we say that the nominal interest rate, it can be the real interest rate plus the inflation. So the nominal interest rate, it is minus inflation, or we can write it in another way, that the nominal interest rate exactly is nominal interest rate, it is exactly is the real interest rate in addition to the inflation. Okay, so I took in consideration the 2 equations where they are important for me. The real interest rate is the nominal minus the inflation rate, and the nominal is the real interest rate plus the inflation rate. So, and this is inflation, it is the expected inflation that we take it in consideration based on what we call it inflation premium, the extra inflation. If there is high risk, then the inflation will increase. If it is low risk, it will then the inflation will decreases. Okay, then we go for the coupon and we need to calculate the corporate bonds coupon interest rate. So it is a percentage on the par value that we have. If it is paying annually, as I mentioned, so this 1,000, it is the what we call it here, the par value. This is the par value of the coupon. But if I am going to return it back with the same value, this means that the market rate is the same. So this 1,000, I'm going to determine on it the coupon rate. It depends if it is monthly, yearly, quarterly. So I will be highly affected by the percentage. So if it is 9% or 8% from this 1,000, then it will be 80 yearly. If it is semi-annually, then I will take this 80 divided by 2. If it is quarterly, then this 80 is going to divide it by 4. This is the meaning of the bonds. So another factors, as we mentioned, it is the maturity, when it will be expired. What is the maturity date? After how many number of years I'm going to give it back? So this is what we call it corporate bonds. When the bonds here, it is estimated according to its reputation. If it is a good bond, then it is having a trusted and its score A according to the standards of Bourge, and in this means that this is investment grade, which is high quality, it is trusted, it is good rating, they are never default. They are never say that I'm going not to give you back your money. But when it is a score D, which means default, they can say, no, I don't have, I've been in bankrupt, I don't have that money. If it is C, then it's at the lowest grades, and this is the rating for each of whatsoever bond valuations for certain bond rating. So let's go for the different types of bonds. We have 4 types of bonds here. I'm going to explain specifically the treasury bonds and the corporate bonds. Treasury bonds, we name it at the beginning. It is the short term, that instrument that the government uses. It is short term. While the corporate bonds, it is another one of the bonds that the businesses needed and they need to finance. And this is related to businesses. Business. Okay. And if we go for municipal, it is related to the municipal that exists in the USA, that each municipal it's issue its own bonds to finance its the budget. And then we go for the foreign, when I issue bonds with the foreign currency, and this is what we call it foreign bonds. So these are the classification. Let's see what are the difference between the first two, and then we go for valuation for the different types of bonds. So if we start to buy the treasury, as you see, it is the refer to the government's bonds, and it is issued by the US federal or NECB, and they are having no default. The meaning of no default, they are going to pay back the promised payment. They are never say, no, I will not give you back money, and then I will trust you, and then I will return back the money. What is the corporate bonds? The corporate bonds, it is another type, but it have a risk, credit risk. It can be credit risk, it can be instability, it is a volatile environment. So this is what we call in corporate bonds. And we have different types of level of default. It can be the default for liquidity, virginity, currency risk. We have according to different types of risk. So let's go for the valuation that we come to. The valuation, which means it linked with the flow of money that we have it according to certain time frame, and then we are going to measure the risk that we have it here. So let's look for the formula. Since we are trying to make present value, I need to find the present value of this calculation. So I need to find the PV. What is the PV, which means the present value? What is the present value? So we need to recall back the formulas of the present value, which is the future value for the cash flow divided by 1 plus the interest rate that I have. Here's come the trick. Here's come the problem. Here's come the most important one, which is the R. When we are discounting according to the market rate. Market rate. We're not going to discount according, so this R, it is related to the acquired or discounted rate, and here I'm saying it is market rate. So there is a difference between the coupon rate and the market rate. So here the cash flow is expected flow. So this is the coupon value, the amount of coupon value. And this coupon value, it is according to the coupon rate, which is the constant rate that we have. But the market rate, it changed because I make an agreement right now, and by time, the market rate, it either can increase or decrease. So that if I agree on a coupon rate 10%, and all of a sudden, after 2 years, the market rate, it changed. It can be 8%, or by time it can be 12%. So this is the differences. So when I am finding the present value of valuation of the cash flow, what is the cash flow? This cash flow, as I mentioned, it is the coupon value. As if it is the payment that I'm going to pay it, and then the final principal that we are going to find it for this problem. So let's see numbers in order to understand more what we will have. So let's say, for example, here we have a bonds, and this bond par value is 1,000. And they are paying an interest rate 10-year bond valuation. Interest, it can be semi-annually, it can be yearly, but here I'm going to find the $100 of interest, $100. What does this mean? That each one of these years, I'm going to pay 100, 100. How many 100? I pay 10, 100, so this is 1,000. So I will take the contract, and then in return, I will receive hundred of dollar, and in the final year, I will receive the 1,000. So this is two things. Yeah, so first, I receive 100, 100, 100 for 10 times. So basically, it is 100, 100 each year. I receive the coupon value. So the coupon value, it is 100. How many number of 100 times 10? Then I will have 1,000. In addition to this 1,000, at maturity, at the end of date, at the end, I will have another cam 1,000. So this is great. So when I'm trying to discount these values, I'm trying to discount it with the 10%, assuming that the market rate equal to the coupon rate. If the market rate equal the coupon rate, then there is no losses, no gains, because nothing has changed. So what happened if the rate change of the market? What we will see. So as I mentioned, if I discount, let's say I am the issuer, so the government is the issuer and issue a coupon rate, coupon rate. How much this coupon rate? It is 10%. Perfect. And after a while, they have commitments. They agree that they're going to pay $100 in this par value, which is the 1,000. So this is the commitments that I have, $100 coupon value. So what happened if the market rate, it's become 8%? So this means that I finance my debt. How much I finance? I finance my debt with cost. How much? I agree upon 10%. But what happened in the market? The market rate declined. So I am here, I'm financing with a higher rate. Okay, so when I finance with a higher rate, so I agree to pay 10%, while if I wait a while, I will can pay for 8% instead of 10%. So here, this situation, we name it premium. Why it is premium? Because when I'm discounting the value at 8%, it will be higher in value, which means that when I find the present value of the bond, which is 1,134, which will be greater in value than the 1,000 that I will pay. So this is why we name it premium, and vice versa. If in market rate, it's become 12%, and I agree to finance, and I did the finance of my debt by with the cost of how much? With the cost of 10%. So this is great because this called discount. What do you mean? That I finance it with the lower cost. And you will see here that the present value will be 887, which is less than the 1000. So I finance it with the cheaper. So as I am an issuer, then I will finance it with the lower cost because I make the deal with 10 and tomorrow the market rate increased by 12%. So let's see how we can do this calculation. We're going to record the time value calculation to understand how we can going to calculate. So let's see here. If I issue at $1,000 par value and it paid the 10% for 3 years, and the interest rate is for the coupon rate is 10%. So 1,000 times 10%. So I will discount the 300 for the 3 years with an interest rate. Pay attention. I didn't use the 10%. I used the required rate of return of the market. The market had changed. So remember here that when we look, I make an agreement with the 10%, and this agreement of 10%, I agree to finance with the 10%. And next year or next day, it's become 12%, which is the market rate or the required rate. So here, this is good for the issuer because they are going to finance with a discount. And how we can find this discount? If we go for the discounting, 100 divided by the market rate, which is the 12, and the 1,000 divided by the market rate with the power 3 to present value. This is the lump sum fixed amount after 3 years once, and but here it is called annuity or installment ordinary annuity. We can use the table, you can use the calculator, you can use the Excel. But when you find the value of the bond by discounting to find the present value, you will find it will be 952. This is very nice because we understood that we finance it with a lower cost. So this is when we discounted for 3 years. But what happened if I am going to discount it with a different number of 2 years? Instead of 952, it would be 966. It is discounted, but the value increases. If I discounted with 1 year, so it will be also because the interest rate of the coupon rate is 10%, while here the market rate is 12%, I discounted with 12%, so it is usually as well, it is with discount. Perfect. But what happens if the interest rate has become 8%? If it is 8%, this means that I will pay more. And this is when we discounted the 3 values, then you will find it is 1,052, which is, we call it premium. I pay more. This is called a premium. So either you can use the calculator, you can use the tables, you can use the formula, you use the Excel. And when you substitute by discounting with the market rate 8%, then it is premium. If it is 2 years, the value increases instead of 152. Sorry, the value will decreases 136 and then 119. But all means it is called the premium. But let's see and summarize what happened here. So if I am discounting it with a 12% for the 1 year, it is 952, 966, 982. So the value here is increasing because I'm discounting here. And it is here with a discount, while on the other side, it is with a premium. And as you see here, the value is decreasing. When we are approaching to the maturity date, the value of the bond will approach it to its what we call it the face value. So it becomes closer to the face value, which is the 1,000. So after we finish valuation, we go to a new terminology, which is we usually find it is called zero coupon bond. What do you mean by zero coupon? There is no coupon. I'm just discounting simply the 1,000 face value that I have it here with the interest rate that I have. So the value of the bond itself recently, it will be 567.43. So another example for having another problem where we look for the ABC company issued a bond with a face value 1,000 semi-annually. And when it is semi-annually, so first I need to find the bond value, it is 1,000, and then we go for the coupon rate, which is 6% of the 1,000. But is here he said it is semi-annual, so I took this 60 divided by 2, then it is $30. And pay attention, how many number of years? It is 2 years. So 2 years, two coupons per year, then the total numbers of the installment are 4. So 1, 2, 3, 4. So the numbers here has become 1, 2, 3, 4 because I'm going to receive each 6 months an installment. And how long? For 2 years. So 2 times 2, it is 4 coupon values. So I will going to discount it. For sure, the coupon rate is 6% and the market rate is 8%. Then it is very clear I'm going to do it with a discount. Finally, let's find what the meaning of bond yield to maturity. Bond yield to maturity is the internal rate of return required to the present. So if I have a face value and I have a coupon payment and I know the principal, so I can determine the yield to maturity, which assume that all the coupon payments I'm going to reinvestment at this yield. So there is a difference between the yield to maturity of a bond and its coupon rate. They are completely different because the coupon rate is a fixed, whereas the yield to maturity, it is fluctuating over time and it depends on the marketplace. So let's see. If I have a 14 years bond, 10% to coupon, 1,000 par value, and the bond prices is 1,494.93. So I have here the present value. I know the installment here or the coupon values that I have it here. And then I have the face value. So what I'm in need to determine what? The interest rate. So we can use the trial and error by the financial calculator to find how much it is, but we can use also the Excel to find the yield to maturity, YTM, yield to maturity. What is the bond current yield? So we did the yield to maturity, we did the bond valuation, and finally to finalize, what is the bond current yield? The bond current yield is the annual interest payment divided by the bond current value. So let's say, for example, if I'm going to sell these bonds, which is what, 1,000 with 985, and the coupon rate is 10%. So this $100, which comes from the $1,000 times, we have here 1,000, the bond is equal 1,000, and then it is times 10%, then this is called the coupon value, and this coupon value is 100. Perfect. This is the coupon value, and I know that the bond itself in the market, it will be the bond in the market, how much it is. The bond in the market, it is simply will be 985. So I need to compare the current yield. So what is the current yield? A current yield means that I find this is the 100 divided by 985 times 100%. So I'm comparing the gains or the amount I'm receiving with the value of the bonds that I will sell it. So this can give me the percentage, and this percentage is 10.15. I think this is good, then it is better than the 10%. So this is the meaning of bond current yield. So let's see how can I answer a question for concerning bond current yield. So if I have a bond for 7 years, and this is what the left for maturity, the bond have a face value of 1,000 and yield to maturity 8%. So this is important to differentiate between the 8% and the 9%. The 9% is the coupon rate, so 1,000 times the 9%, it is 90. And the 8% here, this is the market rate that I'm going to discount with the 8%. For how long? For 7 coupon values, 90, 90, 90. And for the principal, which is the 1,000, and then I'm going to discount it for 7 years to present. So when I find the present value, since as you see, that the 9% is the coupon and the market rate is 8%, so it is for sure it will be a premium, because the coupon rate, it is with a higher cost than the market rate, so this is a premium. So I know here how much I'm going to sell it, which is the 1052, and I need to compare between the coupon value with respect to the 1052.06. So the current yield is 8.5. Thank you for watching. I wish you understood what we did. We did bond valuation. We need to compare between the premium and discount. We explained the yield to maturity, and we finalized by the current yield. Thank you for watching. Waiting for your comments. Thank you.